Thanks everyone for coming tonight. I hope you guys learned a lot tonight. We're just going to do this little workshop, so investing made simple. I like to keep things really simple. So hopefully this will be helpful to you guys. By raise of hands, how many of you want to achieve financial freedom sooner than later? Raise of hands. Anyone? Yeah? Yeah? Okay, cool. Me too. So the key to achieving financial freedom is financial education, is what we're doing tonight. And then it's taking action as well. So I want you to act on something that you learned tonight. So I just want to get a feel for how many of you are already investing. So by raise of hands, how many of you are already investing in the stock market? So there's quite a few. Okay, good. How many of you have a 401k or a Roth 401k? Cool. How about an IRA or a Roth IRA? Nice. Nice. How many of you know what's inside of your 401k or your IRA? And what you're invested in. And money's good. That's good too. So a few less hands. And I just want to give you a little bit of history of why I started investing. So a while back, I don't know, probably like 10 years ago or something, I was working for a company, and there was a lady that I was working with, and she was quite a bit older, probably in her early 80s, late 70s. And I just, had a chat with her, and she didn't want to be working at that age. She wanted to be retired, spending time with her grandkids and things like that. So she had said that she had gotten divorced, probably like, 15 years earlier or something. It was a little bit later. And he had everything in his retirement account, and he had all of the money, all the finances, things like that. And it just, I just felt so bad. Like, I didn't want her to be in that situation, and I don't want to be in that situation, nor have anyone else in that situation. So I just wanted to start learning about investing and be able to help people learn about investing as well. And so I've been investing in the stock market. Like I started my 401k like over 15 years ago, and then I have some properties that I invest in as well, and just really started doing some research and working with different mentors to just see what really works for investing, just so that I could have that knowledge. And then I started my own business so that I could share that knowledge with you guys. A few reasons why people are not investing. One of the reasons is they think they don't have enough money to invest, and they think it's too complicated. They think it's too time-consuming, and they're afraid of losing money. At the end of the workshop, you guys will be able to figure out how much you need to invest to reach financial freedom, right, which is what we want, and then understand how the market works so you can invest and stop worrying about losing your money in the market. And then you'll discover how to set up your investments very simply, so you'll actually do it. You'll actually take the action. And then we'll talk about putting your investments on autopilot so you can spend your time doing other things that you enjoy. So I just wanted to give you guys a statistic. According to a research that was done by Betterment, they found that the average account, and this is just a savings account or a checking account, had $31,000 just in idle cash, just sitting in the savings. And if you left that $31,000 in your savings account for 30 years, you would lose over $300,000 in lost returns. That's quite a bit of money. By the raise of hands, who wants an extra $300,000? Yeah. That is because of compound interest. Just interest itself is earning money on just whatever you're putting inside of your account. But compound interest is interest that is earned on your interest plus the initial amount you put in there. So you're earning interest on interest. And I have just a little example. So if we invested $1,000 in the stock market with just a 5% return, after 1 year, you would have earned the $50 in interest. And then the second year, you would earn 5% not just on that original $1,000 that you put in, but also on the interest that was in there. So for the $50 as well. So you'd have a total of $1,102.50. So compound interest is just adding upon itself. So on your worksheet, I put a link to a calculator. So you guys can kind of play with the compound interest. So you can see if you have, a lump sum in your savings right now, and if you put it in the market, you could see how much return you would be getting within how many ever years you wanted to invest. The earlier we start investing, the more money we'll have, right? The bottom, this blue part, is just what we put in there. So if we left that in our savings, that's all we would have. But if we put it in the stock market, which averages about an 8% return, we would have all of this in green from compound interest. So that's a huge amount of money that we could have just by starting now, right? The earlier you start, the more you'll have in the end. So this is just a little overview of what we're going to talk about. So we're going to start with investing for financial freedom, and then we'll move to how the stock market actually works, and then we'll talk about our buckets of investing, and then what to put inside of your buckets, and then just kind of autopilot to financial freedom. So let's talk about financial freedom first. The first thing you want to do when you're investing is to know why you're investing, like have a purpose, right? So if you're investing for something in the more long term, then putting it in a 401k is a great idea. But if you're investing something for the shorter term, then maybe you want to do a different option. So just knowing why you're investing in the first place really helps to pick the best investment vehicle for you. So today we're just going to talk about our purpose being financial freedom. So this is just a really easy way to calculate your financial freedom number when you could actually retire or become financially free. So you would just take your expenses and multiply them by 25. It's a really simple way to just get a good start on what you would need to achieve financial freedom. Of course, there's variables and things like that, but it's a good starting point. Just an example, I put if your expenses were $63,000 for the year, it's annual expenses, then you would just times that by 25 and you would have about 1.575 million. So that would be what you were working toward for financial freedom. And then just for those that want the numbers, that would be like a 4% withdrawal rate. So when you're actually in financial freedom and taking your money out, you would be withdrawing 4% and still living off your investment. Let's just take it one step further. So we have our financial freedom number, but how do we actually achieve that, right? So we want to know how much to invest each month to get to that number. So I put this link to a calculator on your worksheet as well. So you can go in there and play with that, which is really cool, I think. You just enter in your income, your expenses, and then if you already have an investment, like a 401k or something like that, then you would enter that in as well. So I actually just went into the calculator and took some screenshots to show you guys an example for that. So what I did was I put in 70,000 for your income, and then I just put in the annual expenses at 63,000, and then I just put 100,000 that I already had invested. So maybe if that's what you already had in a 401k, then you would just enter that in on the current portfolio value, and then it calculates how much you would need to be investing each month in order to achieve that. So we would need to be investing $583 each month, and we could retire in 40.3 years. And our financial freedom number, and it'll show like on the bottom of that page, when you go to the calculator page, it'll show at the bottom the net worth. So that number, your financial freedom number, would be that net worth number, which would be about 1.6 million. So just to show you a comparison, if you increase your investment amount, if we doubled that amount, then we could retire 10 years earlier. So it's really important just to look at, how much you're able to invest and really focus on that. So you can reach, financial freedom 10 years earlier just by increasing your investment amount. So you can just kind of play with that calculator and figure out, when you want to achieve financial freedom and how much you would need to be investing each month in order to do that. So we have gone over how to figure out our financial freedom number and how much to invest each month in order to achieve that, but it might seem kind of overwhelming, like that's kind of a big number maybe. So we just want to get started like where we are now, right? The first thing that we want to do is we want to make sure our finances are already in order, of course. So we want to have an emergency fund set up. And a lot of people do like 3 to 6 months. It really just depends on your preference. And then make sure that you've paid off your high interest debt. So if you have any credit card debt, like at 18% or whatever it might be, make sure you have the high interest debt paid off. And then just know what your income is and your expenses, right? So make sure you have like a budget set up or a spending plan so that you can have your income and your expenses. And then all you would do is just take that remaining amount and invest that. Like it's that simple. So if you know what you want as your emergency fund and you know your income and your expenses, then you can just take the remaining amount and start investing. That's where you can start today. Say, for example, if you had an emergency fund of $6,000 and you already had that in the bank and you didn't have any high interest debt to pay off, and your monthly expenses were, say, $2,000, and your monthly income is $3,000, then you would just take that $3,000, your income, and minus your expenses. And that's what your monthly investment would be. So it's just kind of really simple. As long as you know where you're at with your money, then you can just start investing everything, over your emergency fund. So let's do a recap, and then we can talk about any questions from what I've covered. So we know how to figure out our financial freedom number, right? We can use that calculator or just do a quick, our expenses times 25. And then, we can figure out how much we need to be investing each month. So we can use the calculator to figure that out, or just take a look at our current income and expenses and, what our emergency fund is, and then invest the rest. So we can, start earlier, start now, so we can make that compound interest, all of that green on that chart, start working for us. So a little more about the stock market. And this is just a really brief overview of the stock market. So what exactly is the stock market? The stock market is a stock exchange. So it's comprised of thousands of different stocks that we can invest in. And we get to give our money in exchange for a piece of the company. That's why it's called the stock market. It's a stock exchange. So we're giving our money for a piece of the company. So when people say, I'm investing in the stock market, it just means they're purchasing pieces of individual companies in the stock market, or they're purchasing groups of companies. I just put an example on there. So you could buy individual stocks like Amazon or Google or whatever it might be individually, or you can purchase like a fund that would have multiple stocks inside of it. So you could purchase your Amazon stock with 50 other stocks, or how many ever. There's lots of different funds you can choose from in the market, but that's kind of just like a basic overview of what the stock market is. The stock market has highs and lows. So this is just a graph just to kind of show how the stock market goes up and down, but it always trends upward. On average, it crashes about every 8 years or so. So, but after it crashes, you can see that it continues to go up, right? So it has that upward trend. So just knowing that in your mind, like the stock market's going to crash. So, and I'll talk about this later too, but if we're just patient with our investments, it'll go back up, as we've seen on this graph here. And then there was this study that was done that I thought was really interesting. So I just want you to pay attention to the last two columns here. And it was Schwab that did it. And they just invested $2,000 each year. And what they did was they put it in at the worst time possible into the stock market. And they still returned over $72,000 in the stock market at like the worst possible time. So when it was like super high. And then if you just left your money in a savings account and didn't invest it at all, you would only get a return of about $51,000. So you can see, even if you invested in the worst time possible in the stock market, which on average you're not going to do that every time you're investing, right? It's still better to invest than to just keep it in your savings account where you're maybe earning 1%, if that. So just kind of keep that in mind as you're investing. A quick recap on the stock market. So just be patient with the stock market because it always trends upward, right? Even after it crashes, it comes back up again. And just letting your investments grow over time in the stock market, we can take advantage of that compound interest. And if you are living off your investments, so if you've achieved financial freedom, just be aware to be flexible with the stock market. So if it's a down year, just be flexible and maybe don't go to Tahiti or Hawaii or wherever that year. Maybe hold it off and go next year or something. So just be patient, be flexible, but it always trends upward. So keep that in mind. Okay, we're going to talk about the investing buckets. So the buckets are I just tried to do like an analogy. So the buckets are your 401k, your Roth IRA, your traditional IRA, taxable account, whatever it is. Those are your buckets. So we want to set up our buckets so we can fill our buckets up with stocks and funds. So we're going to set up our buckets and then fill them up. So what I would recommend is starting with a 401k if your company does a 401k match. So a 401k match is just when the company decides that they will match a certain percentage of what you're investing. So that's essentially free money. And raise your hand if you like free money. Yes, thank you, I do too. Okay, so I would start with the company match and invest whatever percentage they match up to. So a 401k is just something that your company would provide for you. It's not something you set up on your own. And then there could be a 401k or a Roth 401k. And so let's just cover the differences between those two really quick. So putting your money in a 401k, you would take your money from your paycheck before you're taxed and then put it into a 401k. And then when you withdraw the money, you'll be taxed on the money. And then the Roth is the opposite. So you'll put money in from your paycheck after you've paid taxes. And then when you withdraw the money, you don't pay any taxes. The second thing I would recommend after you get your company match, after you get your free money, right, would be to set up an IRA or a Roth IRA. And these are just individual retirement accounts. That's why they're called IRAs, individual retirement accounts. And you can just set those up through an online brokerage account. And I'll actually recommend one later that I like. And you can invest up to $5,500 a year if you're under the age of 50. So that would kind of be like the next step after getting our free money. And the reason I suggest going into an IRA or a Roth IRA is because usually 401ks, they have higher fees than if you were just to set up an IRA or a Roth IRA on your own. So you always want to keep your fees as low as possible so you can have higher returns, you can have more money. So differences between the IRA and the Roth IRA, very similar to 401k and a Roth 401k. So the traditional IRA, you would just put your money in that hasn't been taxed yet, and then when you withdraw it, you pay the taxes. And you have to start withdrawing by age 70 and a half for just a traditional IRA. And there is a penalty, a 10% penalty, if you withdraw early. So there's some exceptions, but that's kind of the overall rule for IRAs. And then a Roth IRA, like a 401k, when you put money in, you would put money in that you've already paid taxes on. So when you're withdrawing your money, you won't pay taxes on anything that you've earned or anything you've put into the accounts. So, and you can start withdrawing at age 59 and a half, and it would all be tax-free. And then so you never actually have to pull money out of a Roth IRA. You could leave it to your heirs, like your children or grandchildren or whoever. So if you never need that money, you could leave it to someone else, which is great. And then you can, with a Roth IRA, you can withdraw money that you've put in, not money that you've earned, but money that you've put into it. You can take it out at any time. So if you did have an emergency or something, you could take money out of there if you needed to. But we want to leave it in if possible, right, so we can earn that compound interest. deciding between a Roth or a traditional 401k or IRA, you just want to ask yourself, do you want to pay taxes now or do you want to pay taxes later? So if you think you're going to be in a higher tax bracket later on, then you might want to pay taxes now. So then you would consider a Roth. And if you would want to pay taxes later on, if you think you'll be in a lower tax bracket later on, then you could just do a traditional. And then just that other thing to consider, if you wanted to have access to your money for any particular reason, then you could do a Roth and you wouldn't have a penalty on that. And then I recommend Vanguard for a Roth or a traditional IRA. And they're not asking me to say that or anything, that's just who I use. And the reason I like them is because they have really low fees. And they're actually owned by the shareholders. So it'd be you guys if you were investing with Vanguard. And that just means that they don't have any incentive to charge more because it's owned by the shareholders. So, and by having the lower fees, we get higher returns, which is what we want on our money. So here's just an example of fees. And this is, I just wanted to give you kind of a visual because I feel like people don't pay enough attention to the fees in their accounts, and that can really take away from your investments. So in this example, just paying 0.85% in fees, it takes away 21% of your investment. So over double tithing, right? Like that's a ton of money. So just paying attention to what your fees are is really critical to your investing. And you would lose, in this particular example, you would lose over $542,000 in fees, and you would lose 2 years of retirement, 2 years in financial freedom. So who wants to keep 2 extra years in financial freedom years? And then just a couple examples, just to kind of explain what I talked about. So if you have, just say $1,000 to invest each month, then you could put some of that into your 401k up to whatever the company matches you, so you're getting your free money, right? And then we would invest the remainder in our IRA or our Roth IRA, whichever one we set up. And then if we have more left over, we can choose to go back to our 401k or choose other investments like real estate or whatever else you want to do. And then if you have like a lump sum of $6,000 to invest, you could do $500 in your 401k if that was the match, and then invest $5,500 in an IRA or a Roth IRA. And if the match was lower, then you would just take that remainder and invest it in, go back to your 401k or some other type of investment. Okay, so just a recap on that portion. Just make sure you're getting your free money, your company match, right? So find out, if you don't know, if your company does a company match and get your free money. And then invest in your Roth IRA or your traditional IRA at Vanguard if you would like. I mean, there's plenty of good ones, but that's who I like. And then any extra money, you can go back to your 401k or invest up to, you can invest up to $18,000 per year in your 401k. So depending on how much money you have to invest, you could do a lot, right? And then other investments. Okay, so we're gonna talk about what to put inside of our buckets, what to put inside of our 401k or our IRA. Just a few considerations, like there's no perfect investment, so don't be trying to stress about getting everything perfect, right? It's just like getting started, you'll become more familiar with it as you go along and become better and better. So don't try to be perfect up front. And then the higher the risk, the higher for potential returns. So just kind of keep that in mind. If you're really risk adverse, there's a higher, there's the potential for higher returns with that higher risk. And then just to reemphasize, we want to keep our fees as low as possible so we can keep as much money as possible. So let's talk about risk tolerance. And all risk tolerances is just your asset allocation. So that's just how much you're going to allocate to bonds and how much you're going to allocate to stocks. That's it. So pretty simple. So there's just two types. There's stocks, there's bonds. And then the stocks are riskier, but they have potential for higher return. And then bonds are lower risk, still a risk, and then usually lower returns. So just kind of ask yourself when you're deciding your percentage of stocks to bonds, if you see that your investments are dropping, if your funds are dropping, do you think you're going to just like pull out? Do you think you'll freak out and just sell all of your investments? If so, you want to be a little less risky. And then if you need to withdraw your money sooner than later, then if you think you're going to pull your funds out, if you see them start to drop, and you're going to need your money sooner than later, then you would have a little bit lower risk tolerance. So you would have a little lower percentage in stocks. And then there's a rule of thumb in case you just want a number to go from. And it's just your age minus 10, and that would be the percentage you would put in bonds. I'm a little more risky, so I don't actually follow this rule of thumb, but you guys can. So just for example, if you were 35, you would just minus 10, so it'd be 25, so you'd put 25% in bonds and then the rest in stocks. And, and then over time, you can just kind of adjust your investments as you get closer to financial freedom. Just increase your amount in bonds and decrease your amount in stocks. So let's just do a little information about stocks themselves. Okay. So the purpose of stocks is to give us higher returns. That's the purpose that we're looking for when we invest in stocks. And you can do that with individual stocks, or you can put your money into funds, which just have a ton of stocks inside of one fund. So there are 3 types of these funds. And the first one is actively managed funds. These are going to be a little bit more expensive. So the expense ratio, like we talked about, would be higher on these because someone is actively managing these funds. They're going in and selling stock or trading stock or whatever. So they'll be a little bit higher. And then as far as minimums go, a lot of these funds are $3,000 to $10,000 to invest in. And these would include target date funds. Maybe you guys have heard of those. How many of you have heard of target date funds? So it's just one fund you can invest in, and it has a certain percentage of stocks and bonds based on when you're going to retire. So it'll be a target date retirement fund of like 2045 or something, and they'll adjust the fund for you. So as it gets closer to 2045, they'll increase the amount of bonds, and you don't have to do anything. So that's an example of an actively managed fund. Okay, and then the next one is index funds. And these ones are just funds that track something else, just track another index. So these will be lower in fees, and these are usually what I invest in because we want to keep our fees as low as possible, right? And the minimum amount to invest in these type of funds is usually $3,000 to $10,000, just depends. And then there's the last one. And this one is great. It's ETFs, is what they're called, exchange traded funds. And these are similar to index funds in that they're tracking something else. So they'll still have a lower expense ratio, which is good. And you just pay the price of the ETF itself, and they're usually lower price. So you're not going to see like a $3,000 or $10,000 price for an ETF. So they could be, anywhere from like 50 to 200 or something, just depending on which one you're investing in. So there's those 3 types of options. Something to keep in mind when you're investing in funds, the more stocks inside of one fund, the more diverse it is, so it decreases your risk. So if you're just investing in a fund that has 50 stocks inside of it versus a couple thousand, and a couple of companies go out of business or something, it may affect the fund that has less stocks in it than the one that has more stocks. So you're just decreasing that risk by having more stocks inside of your fund. Bonds, similar to stocks, so you still have the same type of funds in there. So you could do an index fund or an actively managed fund. And then their minimums are a little bit lower, maybe around 1,000 or so, depending on the fund. And then you could do the ETFs as well, which will just be the price of the ETF, which is usually lower. So depending on what your preference is, if you just want to be completely hands-off, then you could do just a target date fund. And if you want to just put in a little bit of effort, you could do an index fund, just a stock index fund and a bond index fund. For bonds, the purpose for bonds is to reduce our risk. So we want to go with the least risky bonds. So, we're being riskier with our stocks and then less risky with our bonds. And when you're looking at bond funds, there's a scale. And the least risky are the higher quality, which is a AAA. So when you're looking at different funds, just kind of look for the AAA in there, or the next highest. Any with A's in it are going to be the least amount of risk. And then the same with bond funds and stock funds. The more you have inside of your fund, the less risky it will be. I just wanted to give you guys an example of some funds at Vanguard that I like. So this would be an example of an asset allocation that you could do. So if you wanted to do 90% in stocks, then you could invest in what's called their total stock market index fund. So it follows the total stock market. So there's thousands of stocks inside the fund. So it's a really good fund because it follows the whole stock market. And I put on here the names of each one. So Vanguard has these 3 different versions that you can buy. So if you had $3,000 to invest, you could buy their investor shares version is what it's called. And that would be an index fund. So their ticker symbol is what it's called, their code for it, if you will, is VTSMX. So if you're just searching on their site, you could type in VTSMX to find that fund. And if you had $10,000 to invest instead, you could do their Admiral Shares Fund, which has a lower expense ratio, and that's VTSAX. VTSAX. And then they have the ETF version of it. So that would be, I looked it up the other day, and it was about $132. So you could invest in that one, and that's called VTI, is the symbol for that one. And then as far as bonds, if you wanted to do an investment in bonds, they have one that follows the total bond market. So you can choose one of these versions as well, and it's called VBMFX. Okay. And that's the one that would be $3,000 to invest in. And then the other one, the Admiral Shares, is VBTLX, and that would be $10,000 to invest in. And then they have their ETF, which is BND, is their symbol for it. And that was at about $81 when I checked. So it's just kind of an example, you can just do, one fund, one stock fund, one bond fund, and just pick your allocation. Investing can be pretty boring, but it's, as we've seen, we can take advantage of the compound interest that we'll be getting and achieve financial freedom, right? So, when we're working hard at stuff, like going to the gym and, feeling really good after our workout, we are more prone to work hard for something, but we can just keep investing really simple, keeping it just to 1 or 2 funds, or 3 funds if you want. Just keep an eye on your fees and just remember to get your free money, right? That's what we want first. And then you can set up an IRA or a Roth IRA. And then, just determine how much you want in stocks and how much you want in bonds. And you can choose something just really simple to invest in. If you want to find out more about me, wealthytiffany.com is my website. You guys, I hope you enjoyed this. I hope it was helpful, and I want you to take some action. So go get your free money. Thank you.